Hi everyone, thanks for joining us today. I will apologise in advance, I'm a bit croaky today, but we'll see how we get on. So what we're going to be chatting about is tax for property owners, and I like to describe this as a bit of a whistle-stop tour. So I am going to touch on as many areas and elements of property ownership as I can. I might not go into great detail on all the areas, so if you've got any questions, as Joe said, if you can put them in the Q&A box, and we will try and answer as many live as we can at the end. And if we need to, we can come back to you by email for any more that are a bit in depth. So let's have a look at what we're going to be covering today. I'll start out with who we are, if you're not already familiar with Rotherham Taylor. We'll talk about the property journey, and then we'll move on to the various taxes. So we'll start with stamp duty. We'll look at income tax and allowable expenses, non-resident landlords and how they're affected, making tax digital, capital gains tax, property business structures, furnished holiday lets, inheritance tax, and finally how we may be able to help you. So starting off with who we are, I'm Simone, I'm the tax manager at Rotherham Taylor. We're a firm of chartered accountants and tax advisors based in Preston in the Northwest. We firmly believe that our clients deserve an accountancy and advisory solution that works the best for them. So that's why we tailor our services to their specific needs. So if we have a look at the property journey, these are the three main areas that you would come across when it comes to property ownership, and the associated taxes that come with those various stages. So when you purchase a property, you may initially have to pay stamp duty based on the purchase price. Moving on with the life of the property, you may decide to rent it, in which case you may need to pay income tax on any profits generated. And then at some point, you may decide to either dispose of the property through sale, or it may pass on death as part of your will, in which case you may need to consider capital gains tax or inheritance tax. So what we'll do throughout this webinar is we'll try to follow this property journey, which brings us nicely onto the purchase of property and stamp duty. So I'm sure if any of you have thought about purchasing a property recently, that you've notice that the rules are slightly different if you own a second property, which is generally the case for most landlords. So the rules changed in April 2016, and if you own a second property, you're now required to pay an additional 3% surcharge on top of the normal stamp duty rates. There was a stamp duty holiday following on from all the COVID restrictions to try and bump start everyone to be buying and selling property again. But unfortunately, the latest reduction in rates ended on the 1st of October 2021. So we are back to the normal stamp duty rates now. So if you own a second property, these are the rates that you would pay. If you're lucky enough to find a property that's below £40,000, you would still be exempt. Between £0 and £125,000, normally a residential buyer would pay no stamp duty at this point, but because of the extra 3% rate, a second homeowner would pay 3%. 125 to 250 is 5%, 250 to 925 is 8%, 925 to 1.5 million is 13%, and anything above 1.5 million is 15%. So it's just worth mentioning that these rates aren't applicable to the whole purchase price. These are bands. So for example, if you bought a property for 150,000, the first 125,000 will be at 3%, and then the remaining 25,000 would be at 5%. So that's the tax that you would pay on purchase. If you were to then decide to rent your property, you will be looking at paying income tax on the profit that you make. So this isn't the rent that you receive. This is effectively the money that you have left after you've paid your expenses out of the rent that you've received. So one of the biggest questions that I get asked is, would I be better to hold the property in my own name or in the company name? And one of the best ways that I can demonstrate what the differences are is with a comparison of what the tax payable might be. So I've just picked these figures out of thin air, and this is sort of the biggest difference that you would see, because I've used the highest personal tax rate that most people would pay, which is 40%. So based on rental income of £12,000, say you had expenses of £3,000, that would give you a profit figure of £9,000. Now, it did used to be the case that you could deduct mortgage interest, which is known as finance charges, as an expense, but the rules have changed over the last 4 or 5 years. And we're now at the point where mortgage interest isn't considered an expense for an individual, but it is still considered an expense for a company. So you can see in this example how an individual's profit would be 9,000, but a company would get to deduct the mortgage interest, leaving a much lower profit figure. On this profit figure, you would then work out the tax payable. So as I said, I've just used the personal tax rate of 40% here to give you a good example. Companies would always pay tax at the corporate tax rate, which is currently 19%. It is due to increase to 25% in a couple of years, but that's only for companies with profits above a certain level. So we are expecting most landlord companies to still be paying tax at the 19% rate. So that would give you the tax payable figure for a company. For an individual, that would be the tax due. And then this is when the mortgage interest would come back into play. So although you can't deduct it as an actual expense, you are entitled to a 20% tax deduction for it. So you wouldn't deduct in this example, for example, a £6,000 mortgage interest expense. You would calculate 20% tax on that figure and then deduct that from the tax that's due to bring you back to the tax payable figure. So as you can see in this example, the tax payable for an individual and a company is quite substantially different. So in some circumstances, it can be better to be a company, but if your tax rate was 20%, a company's tax rate is 19%, so the tax difference will be much lower. So following on from this, what expenses can you claim? So you can deduct expenses from your rental income as long as they are wholly and exclusively for the purposes of renting out the property. And what that means is that you have to ask yourself the question, do I need to pay for this, this expense to enable my business to run? And am I only paying for this expense for my business? If the answer to both of those questions is yes, then you're pretty much guaranteed that that expense is allowable. If the answer to one of those is no, you may just need to consider it in a bit more detail, but it doesn't necessarily mean that it's not allowable. So we pulled this list pretty much straight from HMRC's website. So the expenses you can claim for are the biggies, really, the things that you would always ask yourself the question, do I need to pay these for the property business? And am I only paying them for the property business? And the answer is yes. So general maintenance and repairs to the property. So that is bringing the property back up to its original livable standard using modern day equivalents, but not improvements. So for example, if you replace just a regular kitchen worktop with a granite worktop, if you put extra cupboards into a kitchen that weren't there before, if you add an extension onto the property, those aren't considered repairs, so you wouldn't be able to offset those against your rental income. Water rates, council tax, gas and electricity. Generally, these are the things you would only tend to pay for if you've not got a tenant in the property, but as long as you are between tenants, you are still fine to treat them as an expense. Insurance, whether that be a policy for the building or if you let in the property fully furnished, the contents insurance or perhaps public liability insurance. Any services that you provide, so for example, if you pay for a gardener or a window cleaner to come out. Of course, letting agent fees, management fees and accountancy fees are all fine. And another one is if you pay legal fees to renew a lease, those are fine as long as the lease is less than 50 years long. Anything longer than that, you need to check with your advisor. So a few more. As I said, accountants' fees, ground rents and service charges, if perhaps it's a flat that you own. And then the two smaller ones that not many people consider, but are genuine expenses in their own right. So direct costs, so stationery, have you had to draw up a contract for your tenant? Have you needed to post something out to one of your tenants? Advertising, telephone calls is a bit more difficult to claim for. You would need to really look at how much you use your phone in relation to the property, whether that's contacting tenants, speaking to your letting agent, for example. Vehicle running costs is my favourite. You can technically claim a proportion of your overall costs, but I find it's much simpler and easier to just claim a mileage rate, which is 45 pence a mile up to 10,000 miles. So if you keep track of anywhere you've had to go in relation to the property, either visiting the property to run your normal checks, perhaps you've had to go to a supplier to pick up materials. It may only seem small at the time, but over the course of a year, it can add up to something substantial. Or you do have the option of claiming for the £1,000 property allowance. So if your expenses are relatively small, say, for example, you don't have a mortgage on the property, and you don't have a letting agent, and it only needs a very few repairs in the year, rather than claiming for the actual expenses incurred, you can claim £1,000 instead, which can be better if your expenses are below £1,000. So it wouldn't be complete if we didn't talk about the expenses that you can't claim for. So you can't claim for the full amount of your mortgage payment. You can only claim for the interest element. As I said, telephone calls are difficult because it's hard to differentiate between how much of your bill relates to private calls and how much relates to business calls. HMRC specifically say that you can't claim for private calls. So it does require some quite complex calculations sometimes. A strange example to be on HMRC's website, but you can't claim for clothing and personal expenses. But if you ask yourself those two questions, is this expense needed and only for my property business, it's very unlikely that you would end up claiming for a personal expense anyway. If you should require a bit of bedtime reading, there are examples that can be found on HMRC's website. I'll put the link on here, but it is quite long. So if you were just to Google HMRC rental expenses, you would come across it quite easily. Now, I know this won't affect very many people, but I do like to talk about non-resident landlords, just because it's one of the areas that doesn't come up on webinars often, but it's often non-resident landlords who need the most advice. So I will just run through this quickly. So a non-resident landlord is different to being non-UK tax resident. You only actually have to live outside the UK for 6 months to be a non-resident landlord. So you could actually be a non-resident landlord, but still be UK tax resident. So it is important to realise that they are two different things. And the non-resident landlord rules don't only apply to individuals, they do also apply to companies and trusts. The main difference for non-resident landlords is how they pay their tax to HMRC, and there are two ways that they would do this. And often people think the optional method is actually the default method. So the default method, which would apply unless you specifically apply for the optional method, is that it's actually your tenant or your letting agent that is responsible for deducting tax from your rental income before they pay the rent to you. So they have to register within 30 days of the tenancy starting. They've got to keep records and submit those records to HMRC by the 5th of July following the end of the tax year. and they have to pay the tax over 4 times a year to HMRC in June, September, December and March. Now, not many landlords want to have tax deducted from their rent before it's paid to them. So what you can do is apply to HMRC for the optional method. You can do that using something called an NRL1 form. And then what would happen is you would declare your rent through a self-assessment tax return, and you will pay the tax by the 31st of January following the end of the tax year. But to be accepted onto that scheme, your tax affairs have to be up to date. So I just wanted to mention that in case you do have any non-resident landlords watching. The big change really when it comes to landlords is that we are going to be moving to making tax digital. I would normally say soon, but we've just had an extension for a year. It seems to be the thing with making tax digital that there's always an extension because HMRC can't quite get there in time for the original switchover date. So if your income, and that's your income, not your profit, is £10,000 or more a year from rental income, then you'll need to sign up to Making Tax Digital from the 6th of April 2024. It was 2023, but we've been pushed back a year. And what that means is that you need to keep records digitally and have digital links going from the source data to the data that's submitted to HMRC. So you would only key the data in somewhere once, and then that data has either got to be submitted through that original software, or say, for example, if you're filling in an Excel spreadsheet, that needs to have the capability to automatically feed the data through to another piece of software that files it to HMRC for you. So we do have another year. There's no need for anyone to get panicked by this now, but you do have some considerations to make. What are you using now? Would it be a good time to start thinking about moving to an electronic bookkeeping system? It doesn't need to be a cloud package or an expensive desktop software. You could use Excel. There are add-on packages that are relatively cheap that would convert the Excel data into the right format to submit it. It's probably time to start keeping your records up to date throughout the year rather than doing them in bulk at the end of the year. That would just get you into the habit of being able to submit quarterly, ready for when you actually have to do it. And if you don't already, maybe start saving for your tax liability throughout the year. At this point, there's not really any suggestion that you would have to pay quarterly, but that's not to say that won't be introduced. So we will probably have more webinars on Making Tax Digital closer to the time, but carrying on through our property journey, as I said, you may get to the point when you consider disposing of the property, either through selling it or if it was to pass on death. So we'll look at capital gains tax first, which is the lifetime tax that would be due on a disposal. So a disposal isn't just when you sell an asset. It also includes giving it away, whether that's for free or for slightly cheaper than what it's worth. Transferring the ownership to someone, swapping it for something else, or if you receive compensation. So for example, if your house burns down and you get an insurance payout, that would be covered by that. So similar to with income tax, I'll just run through a quick comparison calculation, which would show you the difference between you owning a property personally or if you were to own it in a company. So again, I've just pulled all these figures out thinner. The calculations are quite similar. So you would always start with the selling price or the market value. You would deduct any capital expenses. So these aren't necessarily just things that you couldn't deduct as rental expenses. They do specifically have to meet the criteria for a capital expense, which is generally either costs incurred with selling, like estate agent fees, solicitor fees, costs incurred with purchasing, stamp duty, solicitor fees again, or improvements or additions. So when we were talking about general repairs and maintenance, things that at that point would have been considered improvements, this is where you would obtain the tax relief. So things like extensions, conservatories, items that weren't there before. That would bring you to the profit that you have made, which in this case is £180,000. Now, the main difference between individuals and companies is that individuals are normally entitled to an annual exemption every year, which at the minute is £12,300, whereas companies aren't entitled to that exemption. So as you can see in this example, an individual would get the exemption, so the taxable gain would be lower. However, companies, again, pay tax at the corporate tax rate, which is currently 19%, where if you're a higher rate taxpayer, your capital gains tax rate could be 28%. So you can see how the tax difference, again, is higher if you're an individual. That's not to say that a company is always the best option. For example, if this property was owned jointly between two people, you'd be entitled to 2 annual exemptions, and one person may only pay tax at the 18% rate. So there is no one size fits all answer. This is just really to give you a bit of an example as to what the differences might be. So everyone does pay capital gains tax. That now includes non-residents. The rules changed in April 2015 because prior to that day, if you were considered to be non-UK tax resident, you weren't liable to pay capital gains tax on UK assets. So you are now. You can either calculate capital gains tax as normal, like the calculation we just ran through, or you can use something called the rebasing method. So to do that, what you would do is establish the value of the property at the 5th of April 2015, which is the date the rules changed, and that would become your cost value. So you wouldn't use the cost when you first bought the property anymore. You would use the value of it at the 5th of April 2015. The sale price would still be the same, but you could only deduct any costs that you had incurred between the 5th of April 15 and the date that you sold the property. So sometimes that can work out at a lower gain, so you would have to pay less tax, or sometimes doing it the normal way can be better. You can do whatever works for you, as long as you just let HMRC know which method you've used. The other big thing about when you come to sell a property is that you must report the sale to HMRC and pay any capital gains tax due within a certain time frame of completion. This was 30 days until the 27th of October on budget day. On that date, they extended the deadline. So if you sold a property after the 27th of October, you now have 60 days to submit the return to HMRC and pay any tax that's due. Does apply to residential property only for UK tax residents. If you're non-resident, it applies to all property. And it does depend if there's a gain or any tax due. So all I would say is possibly when you're in the run-up to selling a property, to check with your advisor whether you would be liable to make this return, so that you know how long you've got to get that information to your advisor. So when we were running through the calculation, I did mention capital expenses. And I said these were incurred in relation to the purchase or the sale of the property. So it does include the big things like stamp duty, estate agent fees, solicitor fees and accountancy fees, and then the improvement or enhancement costs. So anything that you've added that wasn't there before, or something that you've improved beyond its original standard. Now, not everything that you think about as being an improvement may actually be an improvement. So the best example, and this is one that HMRC uses, is if you have a property that's got single glazed windows, or perhaps they're wooden framed, and you were to replace those with PVC double glazed windows, that's classed as a modern day equivalent material, because nobody would put wooden framed single glazed windows in a property anymore. So that would actually be a repair, not an improvement. But for example, if you were to go one step further and make it soundproofed, that would be an improvement. So I would just say to make sure that you're considering each cost as and when you're incurring it, to make sure you know where and when you can claim the tax relief. And the big thing to remember is that just because something isn't a rental expense doesn't make it a capital expense. So for example, if you've got a property that was never rented out, but you've incurred running costs such as mortgage interest or gas, electric, water, just because you can't offset those against any income because the property is not rented, doesn't necessarily mean you can offset them against the sale proceeds when you come to sell the property. As always, if in doubt, please contact your advisor, and we're always happy to help if anyone's got any questions. Now, when we looked at the calculation, we saw in that example that there was the annual exemption for the individual, which per person is currently £12,300 per year. That's not just per asset, that's for you as a person. So say you were to sell a property and perhaps shares in a portfolio that you have, that would have to cover everything. You wouldn't have one against the property and one against the shares. But there are other exemptions that are available which can be quite generous. There used to be a really lovely one, which was called lettings relief, where if you'd lived in the property at some point before and then let it out, up to £40,000 of your gain on sale was tax exempt. Obviously, it was too good to be true, so HMRC have now changed the rules, and to be able to claim lettings relief, you have to be in a tenant lodger situation. So you now have to be living in the property with the tenant. However, the other great one, private residence relief, is still around. So you would always get an exemption for the period where you actually lived in the property. If you've lived there at any point, you would also get the final 9-month period of owning the property as an exemption. Whether that covers a period where you let the property or not, you would still get the final 9 months. And there are extra exemptions if you move back into the property after a gap. So even if you've rented it out, you may still be entitled to an exemption if you move back into that property before you decide to sell it. As always, with anything that's really good, there are quite strict rules. So it does have to be a home. So you can't just turn up with a camp bed and move back in for a couple of weeks before you sell it. HMRC aren't likely to accept that that's your home. So things like all your possessions need to be there, registered with the doctor and the bank at that address, for example. And your intention does have to be to actually live there. You couldn't buy a property cheap, renovate it, live there for, say, 2 months and then sell it for a profit if it was always going to be your intention to do that property up and sell it on. So some good exemptions. As I said, the private residence relief rules are quite complex, so I would always suggest that you get advice before selling a property just to see if there's a way to maximise the exemptions that you're entitled to. So the big area, the one that people ask about the most, as I said, is how should I hold my property? There are various business structures, so I'll just quickly run through the big ones. Those are personal, joint and partnership ownership, limited liability partnerships, trusts, pension schemes, and then the biggest one of all that everyone's the most interested in, limited companies. So personal, joint and partnership ownership are all quite similar. This is where you own property either in your personal name or jointly with other individuals in their personal names. There aren't any separate legal entities. It's just that, I suppose, with a partnership, the only difference is that that's more of a formal arrangement where you're running a business rather than just owning property with somebody else. So the pros of these three are that your affairs can be relatively simple to manage because you would all submit partnership or individual tax returns. Any profit that's left over belongs to the individuals or the partners. Can be easier to raise finance because all the money belongs to you as individuals, and you obviously have a lifelong history of your own personal finances. And for the joint ownership, you can split profits and gains. So you can ensure that you're using up all the tax allowances and tax bands that everybody's entitled to. However, there are downsides, as with everything. So you're taxed on all the profit that is made, regardless of whether you actually spend the money. We've already seen in the calculations that there's a restriction on tax relief for finance charges, which is, in the majority of situations, mortgage interest. This can cause you to actually make a taxable profit, even if you're running at a cash loss, which isn't great. Individual tax rates go up to 45%. However, if you're lucky enough for your income to go above £100,000, there is a short period of time for income where your tax rate could be as high as, say, 60% when you lose your tax-free personal allowance. And you're liable to pay capital gains tax on profits made on sale of residential property at rates of up to 28%. So there are pros and cons. As I said, there's no one size fits all. Some people will be better running personally, others may be better in one of the other structures. So we'll have a look at these three, which are the more complex ones, so I can't go into them in great detail. And these definitely don't work for everybody. They are quite niche. So an LLP, which is a limited liability partnership, this is very similar to a normal partnership. It's just that an LLP is a separate legal entity, which is the pro. So your personal assets in most situations would be protected. The biggest downside is that you have to file accounts with Companies House because you are a separate legal entity. So it can give you more of an admin burden. You may find that accountancy fees are higher, and it's generally just a little bit more difficult to manage. Trusts, everybody's heard of like the trust fund kids. So the reason that they have these trusts is because perhaps their parents want to give them an asset or income, but they want to protect that asset or income. So these are useful, say, if you've got children that are quite young or they're vulnerable and you want to pass an asset on to them, but you don't necessarily want them to either have the right to sell the asset outright or to spend the money however they like. So with a trust, you can control what happens to the asset and how much income is paid to the beneficiary of that trust. The big downside is that trusts are quite expensive to run, and they generally do have the highest tax rates. For example, a discretionary trust would normally have a tax rate of up to 45%. And if you have a trust for over 10 years, there is an additional 10-year tax charge. So trusts generally aren't a tax saving solution, they are more of an asset protection solution. And pension schemes, the downside to this is that a pension scheme can only hold commercial property, so they really aren't the best for everybody. The upside is that the rental income and the increase in value of the property increase your pension pot. Something to consider. We do have a few clients with commercial properties in a pension scheme, but we would highly suggest that you speak to an advisor before moving into that sort of structure. And then the big one that everybody always wants to know about, a limited company. So a limited company is a separate legal entity to its shareholders. So if you had a property in a company that you were a shareholder of, you wouldn't own that property. The company would own it, but you would then own the company. So the pros, as we saw in the calculation, full tax relief available for mortgage interest. You personally would only pay tax on income that you take out of the company. The company would pay tax on everything that it earns, but at a much lower rate than you. So income and gains are taxed at 19%. And then the other two pros are more around how you would pass on assets. So if perhaps you were thinking of passing on properties to your children at some point, a company can be a good way to go, because each year you could gift shares, say, to your children or family members, And as long as the value of those shares was less than your annual exemption, which was £12,300, there wouldn't be any capital gains tax for you to pay. So you could give away the company slowly over time. And you can have different classes of shares, which enables different levels of dividends to be paid out. So you could, again, transfer some shares of a certain class to your children and pay them a small amount every year and pay yourself a higher amount on a different class of shares. There are downsides though. So for you to actually get the properties into a company can incur capital gains tax and stamp duty, because those are based on the profit you make from when you first bought the property and the current value of the property. There are ways to get around those, whether that's incorporation relief for capital gains tax or becoming a partnership for stamp duty. They are very difficult to claim for landlords because you need to be able to show that you're running as what HMRC define as a business, which is working more than 20 hours a week on the property portfolio and offering services in addition to what a normal landlord does. So we can help you to have a look at those if necessary. Another downside is that for inheritance tax purposes, there's no business property relief. So if you had shares in a trading company that was running a business, generally there's no inheritance tax to pay. But a property company isn't considered to be trading, so there would be inheritance tax to pay on the value of your shares. Can be difficult to obtain mortgage finance as a company, especially if it's a new company, because it doesn't have its own history of income. And if you own property above a certain limit, you may have an extra annual tax charge called ATED. So that's just something to bear in mind. Another thing that some people don't consider is, could your property be a furnished holiday let? So a furnished holiday let is a property that's designed to be let for multiple short periods over the year. If you think Airbnb, you're probably not far out. It doesn't necessarily have to be abroad. And there are some quite good tax advantages as long as you're letting it out with a view to making a profit. So you could claim small business rate relief, so you might not have any council tax to pay. Capital allowances are available on any assets that you purchase, or furniture, for example, whereas in a normal property, it's only replacements of furniture that's allowable. And when you come to sell the property, entrepreneurs relief may be available, which could mean that instead of paying capital gains tax at 28%, you may only have to pay it at 10%. As with all great tax reliefs, there are very strict rules, so you have to meet what's known as the availability criteria. So the property has to be available to rent for 210 days, actually rented out for 105 days, and long-term lets, which is anything more than a month, don't count. There are a period of grace and averaging elections available if you don't meet those availability conditions, which is good because I don't think anyone really met those in 2020 due to COVID. But just something to think about, especially if your property's in an area that's quite popular for tourism. So that was all about the tax on lifetime disposals, which was capital gains tax. So I'll quickly run through inheritance tax, which is due on anything you didn't dispose of during your life that you still own at death. So it's the tax on your estate, which is basically everything you own, whether that be property, money, or possessions. It's due if the value of all those assets is above £325,000. The current rate is 40%. It is possible to get lower rates if you leave a certain percentage of your estate to charity, or if you give things away in the 7 years before death. But the biggest downside and thing to think about is if there isn't enough cash to cover any inheritance tax that is due, then the asset's going to have to be sold to cover that. So you need to bear that in mind when you're thinking about what's going to happen to your assets. So there are allowances available, and I mentioned that tax rates can be lower if you give things away in the 7 years before death. So things that would be completely exempt from inheritance tax, you don't ever have to think about again. is you can give away up to £3,000 per tax year, and you can carry that allowance forward a year. So you could potentially give away up to £6,000. Wedding gifts, which are higher the more related to someone you are. So it's £5,000 for a child, £2,500 for a grandchild, and £1,000 for anyone else. Normal gifts out of income. So this is where maybe you've got excess cash that you're earning, whether that's off investments or rental income. You don't need that cash, so you give it to whoever you want to have it now while you're alive, so that you don't need to worry about the inheritance tax. Just need to be regular though, and small gifts of up to £250. If you were to give something away and it wasn't covered by one of these exemptions, the inheritance tax due on that gift would depend on how many years before death you gave it away. So if it was 7 or more years, it would just not have to be considered for inheritance tax. But the rates are, they do decrease slowly over time. So anything less than 3 years, it just is part of your estate, and the normal 40% will be due. And then it reduces by 8% every year until you get to the 7 years. Everyone always wants to think about how can I reduce tax now? So I always say we can help you with that, but have you considered how you can plan for tax when you die? Nobody wants to talk about death, but I think it is very important that we all consider that. You want to look after your family in life, so why would you not want to make sure that they're looked after when you're gone as well? So there are a few inheritance tax planning points you can consider. Do you gift your property to somebody while you're alive? The downside is that you have to give up the right to the rental income. Can you afford to live without that rental income? And there is potential capital gains tax to pay based on the market value of the property, even though no money is changing hands. Do you put the property into a trust so that it's not part of your estate anymore, but it's still protected? If the value of the property is more than your nil rate band, which is £325,000, you could potentially have to pay lifetime inheritance tax. As I said, there are high income tax rates for trusts and the potential 10-year tax charge, but it can be beneficial to protect the assets. Or do you consider moving the properties into a company and perhaps slowly gifting the shares over time? So this has been a very quick whistle-stop tour. I hope I've managed to touch on everything that you all wanted to hear about. As I said, if you've got any questions, if you can put them in the Q&A, and we'll have a look at those shortly. If you do want us to help you with anything, we can help with everything. These are just the big areas that we tend to advise on, so we can help you decide how best to structure your investment, whether you're holding it in the best way for you, and if moving to a different structure is best from a lifetime tax perspective and inheritance tax perspective. We can guide you on allowable expenditure. Perhaps you're thinking of undertaking a big renovation project and you want to know whether it would be considered a repair or an improvement. We can deal with all tax compliance on your behalf, whether that's helping you submit the 60-day capital gains tax return or helping you to get ready for Making Tax Digital. And even if it's just you would like advice on what tax to pay and when, perhaps you've been doing your own tax return and you just want somebody to have to give it another glance to make sure that you're not missing claiming for anything. We really are here to help you in any way that you need us. So if anybody's watching who doesn't have my contact details, you can either give me a call at the office on 01772 735 865, or you can email me at Simone, SIMONE, at rtaccountants.co.uk, and we will get back to you as soon as we can. So if anyone's got any questions, if you can put them in the Q&A box. We've got one from Vince. So Vince looks after a property for a non-resident landlord. The current letting agent deducts tax from the rental income. And he'd like to know whether that tenant could move to self-assessment at any time. And the answer to that, Vince, is as long as his tax affairs are up to date, so everything that should have been submitted is submitted, there isn't any tax outstanding, he should be able to do that. He would just need to submit the NRL1 form to HMRC, and then they should write back to him to confirm whether they've accepted his application. And then I think it would just be a case of him letting his letting agent know that no tax needs to be deducted.
Okay, well, I think that covers all the questions we had, Simone. Thanks very much for that, and thanks for getting through that. I know you were struggling with your voice today, so I hope you feel better. Thank you for everybody for attending. As I mentioned earlier, we have recorded this webinar, so we will make this available as an on-demand version on the website tomorrow. If you have any more questions for Simone, her details are on the screen now, and I look forward to welcoming you to our next webinar. Thanks very much, Simone.
Thanks, everyone.